So let's talk about banking. What banks do is they accept deposits from savers and use those deposits in order to offer loans to borrowers. Okay? So they're the connecting institution that converts short-term deposits to long-term loans. Okay? And that process is called asset transformation. And the reason banks do it is because it's profitable for them to do that. Because they take the loans, and in order to induce savers to save with their bank, banks pay savers for depositing at their bank. They pay a small interest payment to savers for depositing at their bank. They then use those deposits to offer loans to borrowers. The borrowers pay the banks for borrowing that money, the interest rate we've previously talked about. So banks do this and are profitable because the interest payment received from borrowers on loans is greater than the interest rate banks pay savers for deposits. Okay? So banks make profit off the spread between these two interest rates. Okay? Specifically, the roles of banks: one, identify profitable lending opportunities. This is traditionally when you think of a bank and going into a bank for a loan, or if you're a small business owner, you want to start your business, you present your business plan to a bank and say, can I receive a loan because of this business plan? It should be profitable. Bank does a risk assessment and says, yes, you receive a loan. No, you don't receive a loan. Okay? The second role of banks is this maturity transformation that I just previously talked about, is the transfer of short-term liabilities to long-term assets. Now, what's a liability? Well, liability is, very importantly, a liability is something that a bank owes. Okay? So this is going to be grammatically oriented, but liabilities are claims or money that the bank owes. Okay? And so these include demand deposits by savers. So if we look at these deposits here, it also includes short-term and long-term borrowing. So short-term borrowing being borrowing from other banks that's less than a year or 1 year and less, and long-term debt being borrowing that matures in greater than 1 year. So what's maturity? Well, maturity is the time it takes for a debt to be repaid. So a 30-year mortgage, you have a 30-year maturity. It takes 30 years for the loan to come due. Okay? So liabilities are on the one side of the balance sheet. Assets are on the other side of the balance sheet. Assets are the investments or the cash or the things that the bank owns or is owed to them. Okay, so liabilities are things that the bank has to pay, and assets are the things that are getting paid to the bank, or things that have value that the bank already owns. So these include deposits at the Fed, banks deposits at the Fed, so reserves that are deposited at the Fed, as well as cash that's stored in banks' vaults, other cash equivalents that the bank has on hand that may not necessarily be in the vault, long-term investments, and even some non-cash assets that the bank may hold. Okay, so these are the positives. The assets are the positives to the bank, and liabilities are the negatives to the bank. So what the bank is going to do is take these short-term liabilities, these short-term, for the most part, deposits, and use those deposits in order to offer long-term loans, such as mortgages, car loans, student loans, financing for firms' projects. The last thing the banks want to do is they want to manage risk, and they do so through two different strategies. One is just diversification, so just being invested in a lot of different industries and a lot of different businesses in those different industries. and invested in different types of assets and securities, and also maintaining solvency, meaning banks maintaining a level where their assets are greater than the liabilities and having safety options in case their assets lose value. Okay. All right, so a bank is going to, in looking at how it maintains its solvency, a bank is going to use stockholder equity to remain solvent. And we'll take a look at the balance sheet to address this idea. But before we do that, stockholder equity or bank capital, synonymous with one another, is just the difference between a bank's assets and their liabilities. So for a bank to be solvent, their assets are going to be more highly valued than their liabilities. Okay? And so banks want to maintain some level of stockholder equity just in case their assets lose value and they have to call on that stockholder equity to balance their balance sheet. Okay? Again, just to be clear, solvency is when a bank's assets are greater than its liability. A bank wants to avoid insolvency when its liabilities outweigh or are greater than its assets. Okay, so let's go through a little example where this comes into play. So let's look at some bank we'll call Bank A, and the bank's only liabilities are the deposits of savers. So this is the demand deposits that the bank owes back to depositors should they request it. Okay? So demand deposits make up the entirety of a stockholder's liabilities. So we'll assume that liabilities are equal to $9 billion, which is equal to the total amount of demand deposits. On the asset side of the balance sheet, Bank A has two different types of assets. They have their reserves and cash equivalents that are immediately on hand, and they have their long-term investments, which are essentially the loans that they've made to borrowers in previously that need to be repaid back to them. Okay, so the value of the repayment of the loans is valued at $10 billion, meaning the total amount of assets for Bank A is $11 billion. Their total amount of liability is valued at $9 billion. The difference between the two, between the assets and the liabilities, the total assets and total liabilities for Bank A is equal to the stockholder equity, which is equal to $2 billion. Okay? So aggregating total liabilities with stockholder equity has a value equal to the total amount of assets of $11 billion. Okay? That's just to start off. Bank's looking okay. Bank's solvent, can pay off its liabilities if need be. But let's say something happens. Let's say there's a negative shock to their long-term investments, as in their long-term investments lose value. Let's, like, for example, some loans are not repaid back to the bank. Some borrowers default on their loans, and the bank does not receive repayment. Therefore, their assets, their long-term investments, lose value. Okay? Specifically, their long-term investments lose 10% of their value. Big, relatively large drop. Well, what's going to happen to Bank A? Is it going to maintain solvency? Well, if their long-term investments lose 10%, meaning long-term investments drop down to only $9 billion from $10 billion, now their total assets are only valued at a total of $10 billion when we take into account the cash equivalents, meaning that stockholders' liabilities and stockholders' equity is now greater than their assets. So what's going to happen? Well, there's going to be a reduction in stockholders' equity. Those that own the bank, the owners of the bank, are going to take a loss because the bank's assets have lost value. Stockholders' equity drops by $1 billion. So the stockholders are the ones that pay the cost of the bank losing value, of the bank's assets losing value, okay? Which is by design. Banks hold positive amounts of stockholders' equity in order to prevent insolvency should their assets lose value. Now, the question is, how much stockholder equity should a bank hold? And there's no right answer to that. No general correct answer for that. Because if banks suffer, let's say, a really strong loss in their long-term investments, let's say a 30% decrease, well, what's going to happen? In that case, stockholder equity can decline by $2 billion, but long-term investments and total assets, for that matter, have declined by more than the value of the stockholders' equity. Total assets lost $3 billion in value. Total liabilities didn't change at all. Depositors are still going to want their deposits back, or the bank's still liable to pay back those deposits. But should there be a run on deposits, should all of the deposits be withdrawn, the bank would not be able to pay it all back because their liabilities outweigh their assets. Their liabilities are valued at a higher amount than their assets. In this case, there's not enough stockholder equity to absorb the loss, and the bank becomes insolvent. Okay. That's a problem. Typically, what you'll see is the Federal Reserve step in and either make sure the bank helps the bank pay off its liabilities and then lets it dissolve, or the bank is then purchased by some other bank or some other financial intermediary that that absorbs the balance sheet of the failed bank. Okay. All right. So we looked at an example balance sheet, but in looking at like all U.S. banks, get a little bit better of an idea. So if we look at the asset side first, when we looked at the previous balance sheet, we had these long-term investments. Well, these long-term investments, these are the loans that banks make. And so banks make different kinds of loans. They make commercial loans to firms. They make real estate loans to both households and firms, consumer loans. Okay? So these are for all commercial U.S. banks. So if we look at all commercial banks as of 2019, March in 2019, we see that the total amount of assets was valued at $17 trillion for all U.S. banks. If we look at total amount of liabilities, a little bit more than $15 trillion, most of it coming in the form of deposits. And so if you take the difference between the liabilities and the total amount of assets, bank capital was about $2 trillion. And so you see that the total amount of liabilities plus bank capital is going to be equal to the total amount of assets. So the takeaway for banks is, again, the functions of banks are to manage risk, find profitable financing opportunities, and the asset transformation, where banks are making short-term liabilities available for long-term loans, promoting the economy. Okay. All right, that's it for this video. I hope you enjoyed it. Hope you have a good day. Enjoy.